In this video, I'm going to look at the 5 money draining mistakes that I see early retirees often making. I'm also going to talk about how I think you can avoid them. You see, early retirees often make these 5 money draining mistakes, and they can find that they ruin their plans in retirement. You see, the idea of leaving work in your 50s obviously sounds amazing, but early retirement comes with financial risks, and most people don't always see these. You see, taking money early from your pension and too soon can actually be really dangerous. Likewise, making the wrong choices could leave you struggling later in life. So in this video, we're going to cover 5 critical mistakes that I see people do that drain their early retirement fund. And understanding these mistakes could save you from running out of money. See, this content is based on the current UK rules and regulations, so it would hopefully apply to you. And in this video, we're going to look at some serious problems. First, we'll examine why taking too much money too quickly destroys pensions. Then I'll explain how timing and market crashes can also ruin everything. And I'll show you the tax rules that apply from 2027, because that could also change your planning. And we'll also look at the accidental trap that limits future pension savings. And then finally, I'll explain why people badly underestimate how long they live. See, these aren't just really small issues and minor, but it can cause actually some major inconvenience later on. And these are the mistakes that leave people generally struggling in their 70s and in their later part of retirement. So my name's Zach Hussain, and I've got over 25 years experience of working with people and helping them plan for their retirement. Mistake 1 is taking too much from your pension too soon. See, for most viewers, pensions means your defined contribution pensions put here. I'm not talking about defined benefit or final salary. You see, many people treat their pension like a bank account once it's accessible. They take large amounts out in the first few years and then worry about how they're going to take it out in the later years. See, this feels great initially because you finally have the money available, but this approach creates a massive problem that you can't easily fix. You see, the reality is that your pension needs to last for up to 30, maybe 40 years into the future. So taking too much early means less money stays invested for growth. You lose the compound growth that helps your money last longer. The pot shrinks faster than most people expect it to shrink. And all of a sudden, within a few years, you realise the money is disappearing really quickly. But then you've already taken out far too much to recover. And what then happens is that for some, going back to work becomes the only realistic option. Some people spend heavily on holidays or helping their adult children out, and that's money that they can't then get back. Others will use their money to pay off their mortgage or buy expensive cars with that cash. So these choices feel right in the moment, but can prove costly over decades. But paying the mortgage off might actually be the right thing, and we've done a separate video on that. But the reality is the damage happens silently in the background over many years ahead. Your 70s and 80s arrive, and suddenly there's nothing left at all. Moving on to mistake 2, and that is ignoring what is called sequencing risk in the early retirement years. So sequencing risk means bad returns early in retirement when you're withdrawing money. You see, this timing problem can absolutely destroy your pension pot for good. This mainly affects people drawing regular income from their invested pension. So if the market crashes in your first few years of retirement, it's really going to hurt you because you're taking money out whilst the value is simultaneously dropping. The reality is that the pot never really recovers properly, even when markets improve years later. See, this is different from crashes when you're still working and saving. And that's because when you're working, crashes actually help you buy investments more cheaply if you continue paying into your pension fund. But in retirement, you're selling investments to fund your living costs. So selling during a crash locks in your losses permanently and completely. The money you take out can't benefit from any future recovery. So what happens is then that your pot stays smaller forever because you sold at the worst time. And the reality is that most people don't always understand this risk until it's far too late. They always work on the basis that markets always recover, so everything will work out fine. But recovery doesn't help the money you've already taken out. So managing this risk requires keeping some money in safer places initially. So this is why you need a buffer in cash or short-term gilts potentially for emergencies. Essentially what you're looking to do are find assets that have lower levels of risk attached to them. In the scheme of things, mistake 3 is a relatively new one, and that is forgetting the April 2027 inheritance tax changes that are coming through. So from 6th of April of 2027, most unused pension funds and death benefits are going to count towards your estate. And that means they're going to be counted for inheritance tax purposes under law. Inheritance tax only applies if your total estate exceeds the threshold. You see, surviving spouses, civil partners and charities remain exempt from this tax. So right now, most DC pensions sit outside of your estate completely. But That's going to change from 6th of April 2027, because under the current law, if your estate exceeds the tax thresholds, your pensions are going to get taxed. The reality is that that tax rate is substantial and will significantly reduce what's passed on to your loved ones. So for some families, preserving pensions for children may no longer be the best option. And this is something I've certainly seen over the past few years, where people have been looking at their pension pot as a way of passing on generational wealth. But with these changes coming through, it's going to be a lot harder to do that. And that's why many early retirees now deliberately avoid spending money for their pension for this very reason. They want to pass it on. So they use other savings first and leave their pensions untouched, and they do this on purpose. And that strategy makes perfect sense. But this policy change that's been announced from April 27, I think is going to completely change that. You see, now you need to completely rethink whether preserving your pension actually makes sense. So the flip side of that is, should you therefore spend more of your pension money during your own retirement instead of looking to pass it on? Or should you still preserve it despite the new inheritance tax changes and how they might hit? And this decision is going to affect how much you withdraw in your early retirement years. And getting this wrong could cost your family a huge amount unnecessarily. And of course, rules of thresholds could change again in future government budgets. It's always difficult to plan too far ahead, but you do have to work with the information that you have. And the information is, for some people, inheritance tax changes may change how they withdraw their money in the early years of retirement. The fourth mistake I see people make is accidentally triggering the Money Purchase Annual Allowance, or the MPAA. See, this allowance applies to defined contribution pensions once you start to flexibly withdraw taxable income, which basically means it starts to apply once you start to take out money from your pension pot over and above your tax-free cash. And once that's triggered, you can only contribute much less and receive tax relief into your pension. So currently the allowance is £10,000 per tax year, so this amount may change in future under defined government rules. So what does this mean? What it really means is that if you continue working and start drawing down your pension, you may well be impacted by this, and you may have limitations of what you can put in. See, many people trigger this accidentally without understanding what they've actually done. But you should remember, taking only your tax-free cash doesn't trigger the money purchase allowance. It's only if you start to withdraw an income. So buying a guaranteed lifetime annuity, for example, also usually doesn't trigger the allowance either. But taking even a small flexible taxable withdrawal will change things going forward. Before triggering it, you can contribute much more with tax relief. After triggering it, your annual tax relief limit has just dropped to a fraction of what it may have been previously. You can obviously pay more, but tax charges may apply above that limit. And this matters usually if you're doing phased or part-time retirement work, because you might want to keep building your pension whilst working reduced hours. But if you've already triggered this allowance, you're going to be limited by how much you can pay in. You see, I often see many people just take a small withdrawal just to test things out, and they don't realise that they've just permanently limited their future tax relievable contributions. And this mistake is particularly painful for people in their 50s. They could have had many more years of earning and contributing significant amounts into their pension, but all of a sudden they've just limited it. So under current rules, that reduced allowance applies in every future tax year. The fifth and final mistake is underestimating longevity and inflation over a long retirement. So most people, I find, badly underestimate how long they're actually going to live. The reality is that in the UK, many people reaching 65 live well into their 80s and to their 90s. So many plan for 20 years of retirement when 30 years is often more realistic. Women especially tend to live much longer than they expect to. So if you retire early, you could easily live 40 years afterwards. And that's longer than some people's actual working career. So planning for such a long period feels impossible, but it is necessary. Inflation also makes this problem even worse over such long time frames. So at 2, 3 or 4% inflation, prices roughly double every 25 years. So what seems like enough money today won't feel like enough later on, when purchasing power gradually erodes year after year without stopping. But what needs to happen for you is that your real terms income needs to grow to maintain your living standard. A comfortable income today becomes inadequate 15 years from now inevitably. Most people assume that their spending will drop as they get older, but the reality is healthcare costs and care needs often increase substantially, and you need to cover that cost later on in your retirement years. You might spend less on holidays, but more on staying healthy. So running out of money in your 80s is actually a terrifying prospect for a lot of people. You may struggle to replace income through work at that age as well, so planning conservatively for longevity and inflation protects you from this nightmare. Now, let's work through the key question that I think you should ask yourself to test your retirement plan. You see, have you calculated exactly how much you can sustainably withdraw each year? Do you know what your actual annual spending will be and how accurate is it? Have you done any budgeting? Have you stress tested your plan against a market crash scenario? Do you understand what would happen to your money if the markets did crash? And what would happen if markets dropped heavily in the first few years? Likewise, have you factored in the April 27 rules on unused pensions for inheritance tax? Does any of this change whether you should spend more pension money now or still look to preserve it for your estate? And what impact would that have on your inheritance tax thresholds as well? Could it significantly take you over? Also think about your beneficiaries and spouse of children. What would they like you to be able to do with that money? And likewise, have you checked whether you've already triggered the annual allowance restriction? If not, do you understand how to avoid triggering it accidentally? And also, have you planned for living much longer than you currently expect to? Have you thought about what would happen if you live into your 90s or even beyond that? Have you thought about how inflation will affect your spending over decades? And importantly, will your income keep up with rising costs throughout your retirement? And do you have enough money in safer investments for emergencies? And if something was to happen to the markets, could you avoid selling shares and your pension temporarily and access cash from elsewhere? And the other thing, of course, I'd always recommend is, have you spoken to a qualified financial advisor about your retirement plan? Because professional help could help you avoid making some of these mistakes. Finally, I'd say be realistic, not too optimistic about your retirement spending patterns. The more realistic you are, the better retirement you will have. Let's finish by recapping the 5 mistakes that drain early retirement funds quickly. So taking too much money too soon is the most common problem that I see. So I keep saying your pension needs to last for potentially 40 years from your early retirement age. And ignoring sequencing risk levels leaves you vulnerable to early market crashes completely. Bad returns in your first few years can permanently damage things. And of course, the April 27 inheritance tax changes affect how you balance your spending through your retirement. It's really important that you balance your spending pensions versus leaving them as an inheritance, and think about this really carefully. Preserving pensions for children may not always be the best option now. The new rules mainly impact estates above the inheritance tax threshold, and triggering the Money Purchase Annual Allowance accidentally limits future contributions severely. And I've seen this trap catch people out, and many people doing part-time work in their 50s all of a sudden see that they cannot contribute as much as they wanted to. Likewise, underestimating how long you're going to live and inflation over your retirement can also cause serious problems in the decades ahead. You may well live longer and face higher costs than you expected. See, early retirement is absolutely wonderful, but requires extremely careful financial planning throughout. These 5 mistakes can seriously damage even a large pension pot. Rules can change, and you should regularly speak to an advisor to make sure you are aware of any rules that may be changed. Because understanding these risks helps you make much better decisions going forward. So take time to review your own plan against these problems and consider getting professional advice before making any big withdrawal decision. And honestly, your future self will thank you for being cautious today. So if you did like this video, please do give it a like and subscribe to the channel. We have lots of content around retirement planning. Lastly, good luck and goodbye.